Appreciate you joining
Thank
in.
you. Thank you
Good
very
luck.
much.
As you said, 23 perhaps is going to be a bit of a softish year in terms of volume growth, but it should pick up 6 to 8% is what you said it'll be in FY24. Thank you very much. So there is the management of Galaxy. 17,790 is where we are at on the Nifty. We're down about 70 odd points. Well, let's turn our focus to the earnings corner. This is our special segment, Quarter Se Quarter Tak. We are tracking the oil and gas space. Q3 is expected to see a sequential improvement for most of the companies, barring a few. Probal Sen is energy analyst at ICICI Securities, and he's joining us now to take some questions. Probal, hi, good morning. Good to have you with us here. I want to start straight off the bat with, what your expectations are on Reliance. I mean, I guess the single most important name in that space, or actually for the market as well. It's looking quite weakish, at least on the screen. But in terms of earnings and numbers, what are your expectations?
I think for Reliance, one thing that stands out is that the OTC segment is expected to perform slightly better on a QOQ level. We expect that the OTC segment will definitely improve with the aid of higher refining margins, albeit the petrochemical segment does remain weak, and there was maintenance shutdown on the refining segment as well. But on the overall basis, given the lows that were hit in the second quarter, at least sequentially, we expect that the EBITDA from at least from the OTC segment should definitely be higher, and that is what propels the 11% YOY improvement in overall consolidated EBITDA that we are penciling in, which translates to about 5% sequential growth. Geo continues to sort of show steady growth. Retail continues to grow well. Upstream, of course, is doing better than what it was a few years ago. But of course, I think the next round of real growth will come when the remaining parts of the new fields start the production, which is expected by the latter half of FY24. But till then, I think from where we were rather in Q2, Q3 would definitely look better, and Q4 can probably show better growth on top of that as well, based on what we see on the margins front, as well as prospects for Geo and retail. So overall, we expect about
Sure, got that. So you're saying that overall Reliance can show better growth in Q4, both in terms of Geo, retail, and you spoke about the oil and gas business as well. I wanted to move on and talk a little bit about the city gas distribution companies, because over there Q3 saw record high domestic gas prices. Now this was passed on to some extent, but what do you think the damage would be to the operational performance for names like MGL, IGL and Gujarat Gas?
Well, I think surprisingly enough, the kind of pass-throughs that have happened of the increase in domestic costs, plus the fact that spot LNG prices at least were slightly lower in Q3 compared to Q2, by about, I think, $8 to $10. So to that extent, the margin hit is actually not as drastic as one would expect. And in fact, the impact is actually mixed. If you look at IGL and MGL, for example, the QOQ decline is more in terms of mid-single digits. Whereas for Gujarat Gas, of course, it's the volume hit, particularly from the slightly low volumes at Morbi, that translates into a more than 29% QOQ decline in their overall profitability. YOY numbers still appear better because the base was, fairly weak in terms of, the same quarter last year. So to that extent, YOY, you actually still end up with fairly significant growth, particularly for IGL and even MGL, because volumes have continued to actually remain resilient. And I think that is a big story, in the sense that despite all the kind of price increases they've done and the relative competitiveness narrowing to petrol and diesel, volume growth still continues to be fairly resilient for IGL in particular, and MGL to a lesser extent. Gujarat Gas, as I said, the industrial volumes are struggling to compete with propane right now. So that is a bit of a worry in the near to medium term.
Okay, all right. Hi, Probal. I wanted to ask you about these OMCs. We are celebrating that crude oil prices have come off from the peak. Now, if that's the case, stock specific, there are various other sectors, but OMCs could be beneficiaries as well, because the marketing margins are under pressure. Will they suddenly turn positive? Valuation-wise as well, it has some cushion. So the thesis is that crude oil prices is going to cool off. Will you be positive on these OMCs?
I think there are two parts to that equation. One is crude prices cooling off because of supply maybe becoming more affordable, or crude prices cooling off because demand for petroleum products itself goes for a toss. And I think depending on what answer you get a different thesis, because today what is happening is because crude prices and therefore product prices have come off, your marketing margins for both petrol and diesel have actually expanded quite a bit. Our estimate is that petrol probably made a positive margin of as much as 10 rupees a litre in Q3, and even in Q4 that run rate continues, whereas diesel losses, which were as high as 10 rupees in Q2, also narrowed to somewhere around 6 rupees for Q3. And if we look at the latter half of the quarter, I think they were as low as maybe 1.5 to 2 rupees. So to that extent, the marketing segment obviously benefits quite a bit. However, if you look at the overall earnings, what also needs to be sustained is that GRMs do not collapse because of this decline in crude and product prices. Till now, what has happened is absolute prices have collapsed, but diesel and ATF spreads have continued to remain fairly robust. So you have a sort of an ideal scenario, let's say for someone like an IOCL, because you've got resilient GRMs, which are at least being maintained at a certain level, while marketing losses are basically going away. So that will be a monitorable to really see. My sense is that if you have to look at this space, you look at the companies which have a fairly balanced refining to marketing portfolio, which is why we've always been talking about IOCL as a preferred pick, because they have a favorable refining to marketing mix, and therefore losses in one segment can be offset by gains in the other, depending on which way the pricing and margins move.
Got it. All right. IOCL is your preferred pick. Let's talk a little bit about gas utilities, because over there it's been a double whammy for them. On one hand, gas demand has been on the weaker side. On the other hand, there's a supply shortage as well. There's higher pricing that could impact earnings. So for the likes of GAIL, Petronet LNG, GSPL, do you expect a big cut in earnings, and what would you do with these names?
I think within the gas utility space, while from a valuation front, all three appear to be very, very comfortable. They are fairly robust and solid businesses, and we remain bullish on the space from a long-term perspective. However, for the next 12 months, GAIL, I think, seems to be hurting on both fronts, because what has happened is, despite the favorable price differential between US cargoes and Asian spot LNG prices, I don't think that their trading business will be able to take advantage of it, because right now the priority seems to be backfilling all the 8 to 9 MMSCMD volume that has been lost from Gazprom. And therefore, you don't really have volumes to play with in terms of leveraging this. So from a trading EBITDA perspective, which is what had been driving profitability till a quarter ago, I think that remains under pressure. Plus, because of lower gas volumes, petrochemical and utilization has also sort of taken a hit. So in the short term, I think in the next 9 to 12 months, that will remain under pressure. For Petronet, I think earnings perhaps have bottomed out. I think utilization can only go up from here steadily, given the fact that LNG prices have not really spiked in the winter as was being expected because of favorable weather in Europe, as well as a slower rate of demand pressure from China. So to that extent, utilization may go up a little bit. GSPL, I would think that is a good play, because for a long time the stock has suffered because of concerns around tariffs being cut substantially, given that they had a lower tax rate as well as higher volumes hanging over their head in terms of regulations. Now with the change in regulations, our sense is tariffs will be cut only negligibly, even from FY24, and volumes I don't think will decline much from here. So to that extent, I think GSPL would probably stand out for the next 12 months in that space.
Okay, it was a very exhaustive list of stocks in the oil and gas space. Thanks a lot for prepping us for the earnings this time. Have a great one. Well, that's the word coming in on oil and gas, but don't lose sight of the market. It's a steep cut that we're seeing right now. The Nifty is down 75 points and the Sensex down 300 points. HCL Tech is your biggest loser. We should perhaps draw our attention back to the management commentary a while back, where they said that Q4 in any case is a seasonally weak quarter for them, and the higher furloughs that they saw in Q3, especially in the Asia Pacific region, could spill over into Q4. So they are expecting some caution over there. And there are no deal cancellations just yet, but Europe is one geography which is really getting challenged. So HCL Tech is a big mover on the downside. Let's take a quick break. In fact, we will we'll pose these questions to our technical guest, Mitesh Thakkar. He'll join in for a view in just minutes from now. Stay tuned.